Silver didn't just rise, it broke the system holding it down. For 40 years, silver behaved. Traders learned the rhythm. Prices stretched, snapped back, and stayed inside a managed range. Then something strange happened. In January 2024, silver traded near $23. By January 2026, it was over 117. That's not a rally, that's a repricing. And here's the paradox. The quoted price says one thing, but the real-world cost says another. To actually buy silver, premiums didn't rise a little. They jumped from $3 over spot to 15, a 400% increase in the cost of access, even as the base price tripled. That gap matters to you because price only works if delivery works. And right now, the market that sets the price trades volumes 50 times larger than the metal it can actually deliver. But here's the part nobody is saying out loud. Prices are climbing without the chaos you'd expect from a bubble. No blow-off, no panic, just pressure. So what breaks first? The price or the promise behind it? The official story starts calmly. Silver is volatile, demand is strong, markets are adjusting. But notice what's missing. The explanation never accounts for why the paper price and the physical market stopped moving together. And that's the real event. What actually happened is smaller than a crisis headline, but bigger than a price chart. The spot price kept trading as if metal was abundant. Meanwhile, acquiring real silver started to feel like sourcing something rare. Dealers quoted weeks-long delays, certain products vanished, premiums surged quietly, without drama. This wasn't a spike driven by excitement. It was a grind driven by scarcity. Here's the pattern. For decades, the futures market set the price because hardly anyone asked for delivery. Contracts were rolled, settled, or offset. The system worked because belief worked, but starting in 2024, physical demand stopped behaving like a passenger and started acting like a driver. Industrial buyers locked in supply. Retail buyers stopped flipping. Institutions began asking a different question, not what's the price, but can I get it? Now zoom out. When the market that defines price is disconnected from the market that provides the thing itself, price becomes a signal, not a truth. So ask yourself this. If silver is easy to buy at the quoted price, why is everyone charging extra to hand it over? And once that question spreads, the system doesn't stay stable for long. Here's the claim that changes how this entire story reads. The silver market isn't overheating. It's running out of slack. Look at the evidence. From January 2024 to December 2025, COMEX silver inventories didn't dip. They collapsed. Eligible inventories fell from 290 million ounces to 147 million. That's a 50% drawdown in under 2 years. And the more critical category, registered silver, the metal actually available for delivery, stands at just 124 million ounces. That's it. Now put that next to the paper side. Open interest in silver futures represents claims on metal that exceed available registered supply by roughly 4 to 1. In normal times, that imbalance doesn't matter because most contracts never ask for bars. They settle in cash. But here's the detail that flips the story. Premiums in the physical market exploded while futures volumes stayed calm. Notice what they didn't deny. No exchange claimed inventories were rising. No dealer said supply chains were normal. Instead, the system quietly adjusted behavior. Prices drifted higher. Volatility stayed muted. That's not speculation. That's stress being absorbed. This is how a structural break begins. Not with a headline crash, but with delivery becoming optional in theory and impossible in practice. When even a small fraction of contract holders decides they want metal instead of money, leverage stops being control and starts being exposure. And that's when the market moves from priced to fragile. Now watch how fast this escalates, because once inventories fall, behavior changes upstream. By early 2026, major North American bullion dealers did something they almost never do. They stopped pretending inventory was infinite. Pre-sales were suspended, purchase limits appeared, shipping timelines stretched from days to 6 or 8 weeks. These weren't customer service problems, they were balance sheet decisions. This is where the story echoes something familiar. Bank runs don't begin with panic, they begin with quiet restrictions, withdrawal limits, delays. Temporary rules. The goal isn't to alarm customers, it's to slow the exit. In silver, the same psychology applied. Dealers raised premiums not to maximize profit, but to discourage demand they couldn't replace. Selling metal they didn't physically have suddenly became too dangerous. Here's the normalization nobody should ignore. When a dealer prefers holding silver over holding cash, it's a signal. It means replacement cost is rising faster than price. It means future supply is uncertain, and it means the spot market is no longer trusted as a reference. What used to be a just-in-time supply chain became defensive hoarding, and every restriction reinforced the same message to buyers watching closely. Scarcity isn't coming, it's already here. Once that belief takes hold, the market doesn't need panic to move, it only needs time. Here's where the story stops looking like a typical precious metal cycle. In past silver runs, investment demand came first. Industrial demand followed, then faded when prices rose. This time, it's inverted. In 2025 alone, solar panel production consumed 173 million ounces of silver. Not because prices were attractive, because contracts were signed, mandates were set, and infrastructure was already being built. That demand doesn't care about charts. A company expanding solar capacity or rolling out 5G networks can't pause because silver got expensive. Around 40 million ounces a year go into 5G hardware alone, and there's no substitute that performs at scale. Engineers already reduced silver loading per unit over the last decade. They hit the limit. Any further reduction breaks efficiency. Here's why that detail changes everything. Industrial buyers don't chase price, they chase availability. When supply tightens, they don't sell, they stockpile. And once they shift from just-in-time procurement to strategic reserves, that metal doesn't come back to market. Add in AI data centers and electric vehicles, and the math turns ugly. Industrial consumption alone is approaching, and in some projections exceeding global mine supply. That's not bullish sentiment. That's structural inelasticity. So the question changes. It's no longer who wants silver at this price. It becomes who can afford not to have it. And now the pressure starts stacking. Because while industrial demand locks in the floor, the inventory buffer keeps shrinking. COMEX didn't just lose metal over 2 years. In one recent 3-month stretch, more than 31 million ounces left the vaults. Quietly, no press conference, no explanation. At the same time, registered inventory sat at barely over 120 million ounces, covering only a fraction of outstanding delivery claims. London wasn't absorbing the excess either. LBMA vault holdings fell from roughly 1.2 billion ounces to 900 million over the same period. That metal didn't disappear. It stopped circulating. Sovereigns and institutions pulled it off the table. Now add speed. Dealers restrict sales, industrial buyers stockpile, inventories drain, and futures markets continue to trade as if delivery is optional. That mismatch creates a narrow corridor where everything still functions until it doesn't. This is the mini crisis most people miss. Nothing breaks all at once. The system just loses margin for error. One surprise demand spike, one delivery request wave, one supply interruption, and suddenly the exchange has to choose between changing the rules or admitting it can't deliver. So ask the only question that matters now. At this point, it stops being abstract. This is where it reaches you. When physical silver tightens, it doesn't stay trapped inside vault reports or futures curves. It leaks into real life. Delayed deliveries mean manufacturers can't finish projects on schedule. Higher premiums mean costs get passed through quietly, not as a headline, but as a line item. Solar installations cost more. Electronics margins compress. Infrastructure budgets stretch. And for individuals, the shift is even more direct. What used to be a simple transaction buying a few ounces at spot turns into waiting lists, minimum order sizes, and out-of-stock notices. Buyback policies harden. Dealers demand higher thresholds before they'll even quote a price. That's not volatility. That's friction entering everyday access. Here's the part that feels familiar. It mirrors what happens when confidence erodes in any system people rely on. Groceries during shortages, fuel during disruptions, money during crises. You don't need ideology to recognize the pattern. When access becomes uncertain, behavior changes immediately. People stop asking if the price is fair. They ask if it will still be available tomorrow. If this feels familiar, say so in the comments. Because the moment enough people recognize that pattern, the market moves again. Now step back, because outrage isn't the point. Mechanics are. This doesn't happen because markets are evil or because someone flipped a switch. It happens because incentives quietly line up. The paper market is built on leverage and trust. As long as participants believe contracts can be settled smoothly, leverage suppresses price by creating synthetic supply. But the moment trust weakens, that same leverage turns fragile. Here's the unsettling insight. The system rewards behavior that looks rational locally and destabilizing globally. Dealers restrict inventory to survive. Industrial buyers hoard to protect operations. Institutions hedge against currency debasement. Each action makes sense on its own. Together, they drain liquidity from the very market that depends on circulation. Spectacle plays a role too. As long as prices move calmly, attention stays low. Calm is interpreted as stability, even when it's actually pressure being absorbed. And fear doesn't show up as panic selling. It shows up as quiet accumulation. This is why mainstream coverage misses it. There's no single villain, no crash candle, just a system designed for efficiency, discovering it has no redundancy. When a market built on promises collides with a world demanding delivery, the rules don't break loudly. They just stop working. And once that happens, momentum doesn't ask permission. Now look ahead, because this story isn't finished. It's narrowing. From here, there are two paths and neither is clean. In the first, confidence holds just enough. Exchanges lean harder on cash settlement. Margins rise, rules get adjusted, the paper price lags, but the system survives in form even as physical premiums stay elevated. Silver becomes expensive but still obtainable for a while. The second path is faster and messier. A catalyst hits, a supply disruption, a surge in delivery requests, a macro shock that forces institutions to question counterparty risk. In that scenario, futures stop behaving like price discovery and start behaving like liabilities. Physical metal pulls away. Prices gap, not because of excitement, but because sellers step back. Notice the uncertainty baked into both paths. No one can time which trigger lands first. But momentum already favors one direction. Inventories aren't rebuilding. Industrial demand isn't retreating. And trust, once questioned, doesn't reset quickly. The next move won't come from retail traders or headlines. It will come from a decision made quietly, somewhere institutional, where someone decides metal is safer than a promise. And once that decision spreads, the window closes fast. Here's the insight that ties everything together. This was never just about silver. It's about what happens when a system priced on confidence collides with a world demanding proof. For decades, promises traded smoothly because few people asked to collect. Now, they are. And the moment delivery matters more than quotes, the hierarchy flips. Silver didn't break out because traders got smarter. It moved because trust got thinner. Every premium, delay, restriction, and inventory draw tells the same story in a different language. The paper system still speaks in prices. The physical world speaks in availability. And those two languages are no longer translating. The deeper loop is still open. If this pressure resolves quietly, it sets a precedent. If it doesn't, it rewrites how value is measured. Either way, we're watching the end of a long era where leverage replaced substance. The next chapter isn't about how high silver goes. It's about which promises still convert. If you want to follow how this evolves and what breaks next, stay with this channel.